Imagine this. You open your futures app in the middle of the night. The candles are red, but you tell yourself, it'll bounce. It always bounces. You watch the unrealized loss grow, minus 30%, minus 50%, minus 80%. Liquidation price is just a few $100s away. You add more margin. You raise your liquidation price to give the trade more room. You are not managing risk. You're negotiating with reality. And then it happens. One violent wick. Your position disappears. The app refreshes, and what was your biggest conviction trade of this bull run is now a tiny gray line in your history, liquidated. You stare at the screen, empty. The bull run you thought would finally change your life just burned a hole through your savings in a few minutes. And the worst part? The chart starts bouncing after you're out of the game. This video is not about how to become a trading genius. This is a brutally honest survival guide so you don't get liquidated in the crypto bull run. We're going to talk about why so many smart people blow up accounts, how liquidation really works in your mind and on the exchange, and the exact rules you can use so you're still alive when this bull run is over. Because the market doesn't care how much you need this bull run. But if you understand how not to get liquidated, you finally stop being exit liquidity for everyone else. Let me tell you a story that might feel uncomfortably familiar. We'll call him Leo. Leo wasn't stupid. He had a job, some savings, and like many people, he watched crypto explode in the last cycles. He saw screenshots. I turned $2,000 into $150,000 in one bull run. He told himself, I missed it last time. I'm not missing it again. When this bull run started heating up, Leo began with spot. He bought some Bitcoin, some Ethereum, a couple of altcoins his favorite YouTuber mentioned. He watched his portfolio slowly climb. 5% here, 12% there. Nice, but too slow. Then he discovered futures. Why would I waste time on spot, he thought, when I can do 10x or 20x and make this bull run count? His first futures trade was small. He longed Bitcoin with 5x leverage. The entry was lucky, the market bounced, and in a few hours his small position made more than his whole spot bag had made in days. His brain lit up. So this is how people get rich in a bull run. Win after win, Leo sized up. 5x turned into 10x. 10x turned into 20x. He started leaving positions open while at work, while having dinner, even when sleeping. He checked liquidation prices, but only for a second. In his mind, the bull run narrative, ETFs, halving, institutions, number go up, was a safety net under every risky trade. Then the market had one of those days we've seen over and over again. A sudden macro headline, cascading liquidations, billions wiped out in a matter of hours. CCN.com plus 3 Yahoo Finance plus 3 Blockshare plus 3. Leo woke up to a sea of red. Bitcoin had dropped hard, altcoins even harder. His 20x long was already near his liquidation line. He panicked, added margin from the little spot he still held. The trade survived a few more minutes. Then another flush. Exchange notifications. Position liquidated. One after another. Every high leverage trade gone. He refreshed the app in disbelief. Months of saving, weeks of learning to trade, hours watching tutorials on never get liquidated, all erased in one brutal morning. The bull run wasn't over. But Leo was effectively out of the game. And reality didn't stop to comfort him. While he was staring at his empty futures wallet, the same volatility that wiped him out created insane opportunity for the traders on the other side who had capital, risk rules, and patience. Leo's story isn't rare. On days with big crashes, we've seen billions of dollars in leveraged positions forced closed, entire waves of traders wiped out in a single cascade. A Invest plus 4 BTZO plus 4 Mudrex plus 4. Behind those numbers are thousands of Leos, people who only wanted to speed things up, who believed this bull run had to be the one, who thought liquidation was something that happened to reckless gamblers, not to them. Maybe you haven't blown up an account yet. Maybe you already have. Maybe you in the dangerous phase. UVE had a few big wins with leverage, your confidence is soaring, and you're starting to think you finally get it. This story isn't here to scare you away from trading forever. It's here so that, as you watch this bull run unfold, you can recognize yourself in Leo before the liquidation email arrives. So you can look at your own positions, your own rules, or lack of them, and ask, am I actually trading a plan, or am I just giving the market more chances to liquidate me? Because until you answer that honestly, every green candle is just bait, and every red candle is a test you're not ready for. Why do so many people like Leo get liquidated in a crypto bull run, even when the long-term trend is up and opportunities are everywhere? Let's strip away the excuses and look at 3 layers: your own psychology, your lack of system, and the environment you're trading in. 1. Your own mind first, FOMO. In a bull run, you're constantly bombarded with screenshots. $500 to $50,000. I just caught this insane wick. This one trade paid for my car. Your brain doesn't see the hundreds of quiet, boring, disciplined trades. It sees the jackpot. So when price runs without you, you feel physical discomfort. You jump in late, often with too much leverage, because you're not entering a setup, you're chasing a feeling. Then there's greed. You're up 80%, 150%, 300% on a futures trade, and you could close it, but what if it doubles again? You start talking to the chart. Just a bit more, then I'll close. At that moment, you're no longer trading a plan, you're negotiating with your own greed. You also hate cutting losses. Taking a small, planned loss feels like admitting you were wrong. So you avoid that pain, and in doing so, you open the door to much bigger, unplanned pain, liquidation. You'd rather wait for the bounce than hit the close button at minus 10%. Ironically, that's exactly how you end up closing at minus 100%. And after a few lucky wins, you become overconfident. You start believing you've cracked the code. You increase position sizes, push your leverage higher, and ignore the uneasy voice in your head that warns you the position is too big. You don't realize that the market doesn't care about your recent win streak. It only cares about your risk exposure right now. 2. Lack of an actual system. Most retail traders in a bull run don't have a trading system. They have a collection of screenshots, random tips, and half-remembered rules from different YouTubers. They can't answer basic questions. Are you investing or trading? Are you mostly spot or futures? What's your maximum risk per trade? At what point do you say this trade is invalid, I'm out? Without clear rules, you don't have a liquidation problem. You have a randomness problem. You don't define position size based on account risk. You size based on emotion. A setup that feels right gets 20x. One that feels weak gets 3x. There's no formula, just vibes. You place entries and stop losses after staring at the chart until it makes sense. You don't write anything down. You don't journal. So when you lose, you tell yourself, the market is manipulated, instead of, I oversized this trade, and I didn't respect my own rules because I didn't have any. 3. A toxic environment. Finally, look at where you're getting your information. You live in feeds full of KOLs flexing P&L, TikToks promising zero liquidation strategies, and short-form memes turning highly leveraged futures into something casual and fun. YouTube.com+2 The problem isn't education. There is useful content out there about how liquidation works, why maintenance margin matters, how to size positions, and how to avoid cascading liquidations. Crypto futures trading plus 4 BTZO plus 4 Mudrex plus. For the problem is that the loudest voices in your feed are often the most extreme. They show the upside, not the process. They glamorize leverage while barely mentioning the days when billions of dollars in positions are wiped out in a single liquidation wave. If you consume this every day, you start to see risk as optional. You tell yourself, everyone uses high leverage in a bull run. That's just how it's done. You underestimate how quickly a single violent move can liquidate overexposed traders and turn their bullish conviction into a forced exit at the worst possible price. Invest plus 4 Yahoo Finance plus 4 Blockshare plus 4. Put these 3 layers together: emotional chaos, no system, toxic environment, and liquidation stops being a rare accident. It becomes the default outcome of trading leveraged futures without a plan, especially in a hypervolatile. Now here's the part that might sting. Most people think they're losing in futures because exchanges hunt their stop losses. Whales manipulate the market. News came out of nowhere. Those things do exist, but they're not the main reason you get liquidated in a bull run. The uncomfortable truth is this. Every time you open a leveraged position, you are responsible for exactly how easy it is to liquidate you. No one forces you to click 50x. No one forces you to move your stop closer because you want a better R/R. No one forces you to hold through a major news event with half your account on the line. Crypto is brutal because it doesn't pretend otherwise. There are days when, in a few hours, liquidation waves erase billions in open interest. Leverage magnifies everything: gains, losses, emotions, and consequences. Gate.com plus 4 BTZO plus 4 Mudrex plus 4, but here's the twist. For disciplined traders, those same liquidation events are not unfair. They are expected outcomes of a system where overexposed traders get washed out, and capital moves from the undisciplined to the prepared. Another illusion. You might believe the key is to find a magical, never-get-liquidated setup, some secret hedge or hidden feature on the exchange that lets you enjoy all the upside with no real risk. That's not trading. That's fantasy. In reality, even the best traders accept that losses are non-negotiable. What they refuse to accept is liquidation. They treat liquidation as a design failure, not a normal event. Here's a harsh line that many people don't want to hear. If you can't stay disciplined with a $500 account, you won't suddenly become disciplined with a $50,000 account in this bull run. More money doesn't fix emotional habits, it amplifies them. If you're casual with small risk, you'll be reckless with big risk. If you refuse to cut a $50 loss, you also refuse to cut a $5,000 loss until the exchange cuts it for you. Another unpopular truth. Your small positions are training your future self. When you open a tiny Deegan long just for fun, with no plan, you're not just risking that small amount. You're reinforcing the idea that it's okay to trade without rules. Later, when the numbers are bigger, your brain will default to the same casual behavior, just with more zeros. So what if we invert the usual way you look at this bull run? Instead of asking, how can I make as much as possible before it ends? Ask, how can I design my trading so liquidation becomes extremely unlikely? Not because the market is kind, but because I am disciplined. You cannot control macro shocks, ETF announcements, exchange outages, random tweets from powerful people that move the market. YouTube.com+1 you can control how much you risk per trade, what leverage you use, whether you know your liquidation price before you click open, whether you accept that any single trade is allowed to destroy your account. The real edge in this bull run is not a secret indicator or an AI bot. It's the boring, unsexy decision to trade like someone who wants to be here after the bull run, not just during the most aggressive months. So the question becomes, if you can't control the waves, what can you control to make sure they don't throw you overboard? Let's turn all of this into something you can actually use. Think of this as a crypto bull run futures survival framework, a simple structure to dramatically reduce your chances of getting liquidated. Step 1. Audit yourself and your account before talking about strategies. Look at the reality in front of you. How much of your total net worth is in crypto? How much of that is in spot? And how much is in futures? Do you even know how many open positions you have right now? Write it down. Not in your head, somewhere visible. Separate your capital into core capital, money you refuse to risk in high leverage futures; trading capital, money you are willing to actively trade with strict rules. If everything is in one messy pool, liquidation risk is already high. Step 2. Make risk the first decision, not the last. Before entries, indicators, or patterns, decide how much you're willing to lose per trade. Many experienced traders risk a small percentage of their trading account per position. For example, 0.5% to 2%. The exact number is your choice, but the key is, it's defined before you enter. It doesn't change mid-trade because your feelings change. From that risk, derive your position size based on your stop-loss distance and your chosen leverage. If the math tells you the position is smaller than you wanted, that's not a problem. That's reality telling you. This setup doesn't justify the size you emotionally want. Step 3. Respect liquidation distance. Every time you open a futures trade in this bull run, ask 3 questions. Where's my invalid level? The price where I admit this idea is wrong. Where's my stop loss? Where's my liquidation price? And how far is it from my stop? If your stop loss is just a few percentage points above liquidation, you are playing a very dangerous game. You're depending on the exchange, volatility, and funding conditions to be gentle with you in a bull run. They won't be. Design your trades so that your stop is hit long before liquidation. Liquidation is a distant emergency, not a frequent reality. If you find that with your planned leverage, liquidation is always close, your leverage is too high for this market, or your entry/stop is poorly chosen. Step 4. Simplify your strategy during the bull run. You don't need 10 setups. You need a few simple ones you understand deeply. For example, trend following longs on higher time frames during strong uptrends. Occasional hedge shorts when the market is clearly overheated, with clear invalidation. Focus on higher time frame levels, clear structures, clean pullbacks. Avoid revenge trades, random scalps during extreme volatility, and I'll just try something quick positions. Most liquidation stories are built from those moments, not from patiently executed setups. Step 5. Review, so you don't repeat. Once a week, or at least once a month, sit down and review which trades respected your rules, which trades broke them. How close did any trade come to liquidation? What were you feeling before you clicked open? This is where real progress happens. You're not just looking at P&L, you're studying your behavior under stress. Write it out. You'll start to see patterns. You oversize after a big win. You chase after missing a move. You move stops when you feel embarrassed to admit you were wrong. The goal of this framework isn't perfection. It's to make liquidation so unlikely that when the next billion-dollar liquidation event hits, you're annoyed, maybe stopped out, but still alive, with capital to deploy when the dust settles. Let's step back from charts for a moment. Because if you've ever been liquidated, you know the numbers on the screen are only half the story. The other half is what happens inside you. There's the wave of shame. You might have told friends or family that you were learning to trade, that this bull run could finally put you ahead. Then one day, you open the app, see a near zero balance in your futures account, and your first instinct is to hide it. There's the silence. You bragged when you were up big, showed screenshots, joked about making it. But when the account blows up, you don't tell anyone. You carry it alone, checking charts in secret, replaying the moment you could have closed in profit but didn't. There's the self-blame. You scroll through every trade in your history, thinking, if I had just closed here, if I had just used lower leverage, if I had just listened to that little voice telling me this was too big. And beneath all of that, there's fear. Not just fear of losing money again. Fear that this pattern says something deep and true about you, that you are irresponsible with money, that you can't be trusted with risk, that maybe you're not cut out for investing at all. Here's what I want you to hear clearly. Crypto didn't create those feelings. It revealed them, faster and louder than most other markets. Leverage accelerates everything: profits, losses, and self-discovery. If you tend to chase shortcuts in life, crypto will expose that. If you struggle to admit mistakes, futures will punish that. If you avoid planning and rely on impulse, the bull run will make you pay for it in real time. But that doesn't mean you're doomed. It means you've been handed a brutally honest mirror. You can treat that mirror as a verdict. I am just bad with money. Or as feedback. I have work to do on my discipline, my patience, and my relationship with risk. The difference between people who are destroyed by liquidation and people who grow past it is not intelligence. It's what they decide after the loss. Some quit entirely, but they don't really learn. They just carry the shame into the next impulsive financial decision somewhere else. Others look at the wreckage and say, okay, that hurt. I'm not repeating this story again. They start small. They build rules. They stop seeing each trade as a lottery ticket and start seeing it as one decision in a long series of decisions that will define who they are with money. Crypto, especially in a bull run, can be one of the most intense emotional classrooms you'll ever sit in. It asks you, can you delay gratification? Can you respect risk even when everything feels bullish? Can you stay humble after wins and honest after losses? You don't have to become a perfect trader. You don't have to never feel FOMO again. You just need to be a little more disciplined than you were last month, a little more honest with yourself than you were last cycle. And if you've already been liquidated, you're not uniquely stupid. You're human, in a system designed to punish emotional, unplanned risk. The real question now is, what story do you want to tell about this bull run when it's over? That it was another chapter in the same pattern, or the moment you finally decided to trade and live with more intention? So where does this leave you? We're in a crypto bull run where volatility can erase or create life-changing amounts of money in hours. We've seen single events wipe out billions in leveraged positions, turning overconfident traders into forced sellers in a single day. That's the harsh side of this market. But there's another side. This bull run can also be the time you finally learn to respect risk, define your rules, and stop giving your capital away to liquidation engines and better prepared traders. You don't need to become the best trader on the planet. You don't need to catch every move. You don't need to turn $100 into $1 million for this to be worth it. What you do need is to know why you're in a futures position, to know how much you're willing to lose before you click open, to make sure liquidation is not your exit plan. If this video has done its job, you now see liquidation not as bad luck, but as the predictable result of certain behaviors: oversizing, over-leveraging, refusing to cut losses, trading from emotion instead of from a framework. And maybe, somewhere in Leo's story, you saw yourself. If you did, I want you to do one thing after this video. Tell your story, in the comments, in your journal, to yourself out loud. Not to seek pity, but to take ownership. What was your worst liquidation? What were you thinking before you opened that trade? What will you do differently in this bull run? If this video helped you see crypto a little less like a lottery ticket and a little more like a serious game that demands respect, then consider supporting the channel the simplest way. Hit like so the algorithm knows this kind of honest conversation matters. Subscribe if you want more deep dive content about surviving and actually thriving in crypto, not just hype. And if you're planning to trade on any exchanges, you'll find links in the channel description. Use them only if you understand the risks, know your limits, and are committed to trading with a plan, not out of desperation. This is not financial advice. It's a reminder that your money, your time, and your mental health are real, even when the numbers on the screen feel like a game. And if you're still here, I'll leave you with one last thought. The next time a liquidation cascade hits this market, someone will be wiped out, and someone else will be calmly waiting with dry powder, ready to take the other side. The difference won't be luck. It will be preparation. In the next video, we're going to walk through one of the biggest liquidation events in recent crypto history, step by step, and break down how it was set up, how traders got trapped, and what the survivors did differently. If you don't want to be on the wrong side of that story again, I'll see you there.